Good morning, everybody. My name is Emmy Souza. I represent 13th Floor Homes, which is a builder here in Broward County. We have several other communities now, but right now we're focused on Hidden Trails community where we're building 214 homes. And we have about 30 to 40 homes still available pre-construction. So what that means is if you guys come in and you bring your client, we will be showing them our model homes that are fully furnished, very gorgeous. We'll be looking at a lot of floor plans, and a lot of them are here in your booklet, where these floor plans show the layout of the home, the specifications, 3, 2.5, 1-car garage. And depending on your buyer's needs, we can always look at homes under construction. And then once they finalize which home they like, we get to tour the community, tour the home site or the lot where we would be building their home. Sometimes we have move-in ready homes. I know we all like that, so that you can close within 30 days. But the majority right now are building, take around 6 months to build. All right. The community is going to consist of 214 homes. We have a very low HOA of $45 a month to take care of all the lawn maintenance. There is also a pool cabana, Zen garden, and perfect for families to, enjoy. We have a beautiful Mainlands Park in front of the community that a lot of families and dog lovers are loving. And we're open Monday through Saturday, 10 to 6, and Sundays, 12 to 6. Okay. One of the big differences about 13th Floor Homes is that we include everything you need or your client needs in their home. So hurricane impact doors and windows, first floor, second floor is all included. They're all detached single family homes. And we include really nice included features. So like 36-inch wood cabinets, granite countertops, 20 by 20 porcelain tile, all that is standard for everywhere. Yes, first and second floor. Oh, I thought you were talking about the hurricane impact. The flooring is all the first floor and all the wet areas upstairs. So the laundry room, the AC handler, and all the bathrooms. The stairs is carpet, but what we've done is we automatically upgraded the second floor to have gypcrete. This gypcrete is it's a mixture of gypsum and concrete. So it's a cementitious flooring on the second floor that is not required by code, but we do it so that when people rip out the carpet, you have like that foundation you need to install tile or wood. It's better, it's easier for your client, it's sturdier construction. Offering wood or tile, it gets really expensive, so we just didn't offer it. But we include gypcrete. We don't offer upgrades for carpet. We automatically included the gypsum concrete. So when your buyer comes, they can literally buy a home for the price that's on this price sheet and that I included in your booklet. A lot of times you'll see that lot premiums are an upgrade or cabinets, granite, all of those things that I mentioned are an upgrade. We include all of these things in the price of the home. Okay, so your buyer can walk in for this one, $333,490, and they can walk out purchasing that home. We have plenty of that still available. Yes, we offer $10,000 incentives, of course, through our preferred lender. Don't punch me. But it's tied down to a lender for always like a smoother process. There's been people that do go with an outside lender and it's on a case-by-case basis. So if you do have a buyer that's really strict about going with their preferred lender, that, we just something that we have to talk about. But we give $10,000 incentives towards a closing cost. And our lender does give an additional $2,250. Sometimes if buyer prefer a better rate, then, that closing costs go away, the $2,250, and they get like a better rate. So in total, you could get $12,250 towards incentives. Your buyer can. Great questions. Any other questions regarding included features, homes? We've sold 80% of the community already. So we do have very little left. At this pace, we expect to be sold out by May, but still great opportunity.
What's the commission fee?
3% commission paid at closing. All right, so I hope to see you guys there. We're open. Yes. Are we selling our models? Yes. They're no, fully furnished. We sell them fully furnished, so they sell them for a lot more, right? Typically. The ones that we have in Hidden Trails are not on the MLS yet. A lot of times we do put our models on the MLS, but these we don't have pricing for yet. We usually post it like maybe like a month before community closeout.
First one is 333. So it's going to be furnished.
So we don't have a fully furnished model of the 333 490. I only have 2 models. I have one hammock and one. Are you talking about fully furnished models? Yeah, I have Cypress and the hammock as fully furnished. They usually, I would say worst case scenario, like $100,000 more than what's on there because it's fully furnished. It's on a lot premium. It has upgrades. It's on lot premiums. It's fully furnished. Typically.
Yeah, but it's $100,000.
Typically, yes.
No, but for furniture, that's kind of crazy.
I know. You could probably, I mean, remember the builder pays designers to do this, right? So they're probably. City Furniture has amazing designers. We hired them for one of our models. They're great. They're on premium lots. They have all the upgrades and they're fully furnished. The top floor still has carpet. We always show our homes with what we give you, including carpet. Because we don't. Somebody doesn't like carpet. Yeah. A lot of us Floridians don't like that. Some people do, like a lot of people from up north do, because it's softer and they're used to it. Any questions? The community and everything. I gave you guys my business card. It's attached to the flyer. Feel free to call me. That's my cell phone. If you bring a client, I just ask that you come with them so that we can fill out that broker acknowledgement. And if a contract is done within 60 days with your client, then you're fully going to be included in the contract. All right. Thank you, guys. I'm going to leave these extras and then you can put them over there.
We'll have plenty of days.
Yes. Okay, awesome. And enjoy lunch. Oh, I didn't get everybody's business card. Sorry, I got his. Do you have one? No? Okay. And then I'll just ask you for them. Is that okay? Okay. Jocelyn. No.
Thank you. I have a red light. I'm good. And this is working? Okay, we're ready. Is this other TV going to come on, or is that just what you're going to use to help me with the questions? Question. Okay. All right, guys. I am Chris. I am with America's Mortgage Professionals. I am the preferred lender for location real estate.
And you're breaking stuff already.
Oh, well. Don't worry. It's not mine. Okay. So we've got 4 or 5 folks in the class. There's another 4 or 5 apparently online. If you guys have any questions, just type them on the screen and then we will get to them as we move along. This class is entitled FHA versus conventional. It's designed to explain to you guys the differences between FHA and conventional. Things have really loosened up on the FHA side. One of the things that I hear, and the reason we put this class together, was that people that had been realtors for a longer period of time thought of FHA that was only for first-time home buyers, and that there were a lot of restrictions, that there were problems with the appraisals and all that kind of stuff. So it is not like that at all anymore. So we put this class together to kind of explain the differences. And if I can get this thing to slide over. Come on, work. Tommy, it's not rotating. I don't feel the rotation here. Can you help a brother out here? Come on. Okay, now it's working. Okay, so anytime I give any type of a class or presentation, the first thing I start off with is thanking you for attending. I know you guys could be out selling properties, doing listings, curling your hair. But instead you're here and I appreciate it. Okay. So I want to give you a little background about FHA so that it kind of makes sense to you where it started out and where it is now. During the Great Depression, many banks failed, causing a drastic decrease in home loans and ownership. At that time, most home mortgages were short-term, 3 to 5 years, with no amortizations and balloon instruments, and the loan to values were below 60%, meaning they had to put 40% down, right, to buy a house back in the day. This prevented many working and middle-class families from being able to afford home ownership. The banking crisis of the 30s forced all lenders to retrieve due mortgages. Refinancing was not available, and many borrowers, now unemployed, were unable to make their mortgage payments. Consequently, many homes were foreclosed on, causing the housing market to plummet. Banks collected the loans in the form of foreclosed properties, but the lower property values resulted in a relative lack of assets. So many banks failed because when they did get them back, they were worth half as much. All right. In 1934, FDR created the federal banking system, and it was restructured. The National Housing Act of 1934 created the FHA, Federal Housing Administration. Its intention was to regulate the rate of interest and the terms of mortgages that it insured. The key element to that statement is it insured. FHA is not a lender. It's basically an insurance company, okay? So this is our little FHA logo that they sent us because we are an approved lender with HUD, and we do FHA and VA loans. This is a comparison chart that will compare some of the differences between FHA and conventional. If you guys want to snap pictures of any of these screens, I don't have a problem with that. If you want me to email you a copy of this presentation after we're done, just shoot me an email and then I'll attach the presentation to you and send it to you. All right? So here's the skinny on this stuff. FHA, with regards to loan amounts, we start out at $100,000 on both sides. And then currently, FHA in our county here in Broward, Palm Beach, and Miami-Dade is $373,750, and conventional was just raised up to $510,400. And you'll notice it says it varies by county. Some counties the amount isn't that high of the $373 or the $510. If you get up around Orlando, that number is lower. If you go down to the Keys, that number is higher. And it's also higher over like in the Naples, Marco Island area. There's a difference with regards to the credit score. On a conventional loan, HUD says you have to have a minimum 620 credit score. Over here on FHA, you'll notice it's 40 points lower at 580. But you'll see a little caveat here. We can actually go down to as low as a 500 credit score on an FHA product. But if the score is below 580, the borrower has to put 10% down. Most of the time, people don't have 10% down. Exactly. I mean, if their credit score was higher, they'd probably be paying their bills on time and their score would be higher, right? So that's the kind of the catch-22 there. Also, FHA will do what is known as a no-score loan. Go ahead and ask me that question. What's a no-score loan? Okay. I'm glad you guys are paying attention. So you got a young snot-nosed kid that just got out of college. He's never had a credit card, never had any type of loan at all. We go to pull his credit report and nothing shows up. We can actually get that guy done. We build what is known as alternative trade lines. We get a cell phone bill, a utility bill, a car insurance bill. We track his last 12 payments to those 3 institutions, and we can get that person done. What if mom pays what? As long as the bill is in his name, we don't care where the money comes from. We don't track that.
Does it have to be a year?
Yes, you got to have a minimum of 12 months history. Okay. All right. Now, if we pull their credit report and they don't have any accounts except for 2 medical collections, then they don't qualify. They can't have any derogatory. All right, so bear that in mind. All right, so now let's look at the down payment differences. FHA, it's a 3.5% down payment. Conventional, it's 3% if you're a first-time home buyer and 5% for anybody else. FHA has two types of mortgage insurance. There is what is known as an upfront mortgage insurance premium, UFMIP, that is charged on every single loan, and it's equal to 1.75% of whatever the loan amount is. That premium is financed into the deal. In other words, if we're giving a $100,000 loan, 1.75% of that is $1,750. So that $1,750 is put on top of the loan. They're not writing a check and bringing that to the table. Okay?
Is that for the life of the loan?
That's a one-time fee.
I mean, but it's,
There's two types of insurance on an FHA loan. The first one is this one, which is a one-time fee that's taken care of at the time of closing. And then there's also a monthly mortgage insurance premium as well. Yes, you get hit with both on an FHA loan. All right, so I'm going to explain that. A conventional loan does not have that one-time upfront mortgage insurance premium of the 1.75%. So that's another major difference between the two. Mobile homes and non-occupying co-borrowers. On an FHA loan, we do mobile homes and they do non-occupying co-borrowers. Same thing on conventional. Residence status on an FHA loan, it has to be your primary residence. On a conventional loan, it can be either a primary, a second home, or a vacation property, or an investment home, a rental. The terms of the loans, you got 10, 15, 20, 25, and 30. And over on the conventional side, you've got 8, 10, 12, 15. There's a couple more options in here. The majority of people, 90% of my loans are 30-year fixed rate deals. The mortgage insurance, who is underwriting it? On an FHA loan, FHA underwrites the insurance. On a conventional loan, there are a couple of major companies. The big ones are called MGIC, United Guarantee, and Radion. These are called private mortgage insurance companies, PMI, because these are just an outside third-party company, whereas FHA is underwritten and insured by the government. So one of the things that all lenders and all banks do is they base their interest rate that they're going to offer a client based on what we think our risk is. So in our mind, FHA, which is backed by the federal government, is a stronger entity than a private mortgage insurance company that could possibly go out of business. Okay? So that's why one is called PMI, because it's private mortgage insurance put on or represented by a private company. All right, then you've got types of mortgage insurance. This one, it's just monthly insurance only, and I'll explain that to you here in a minute. On the conventional side, you have some options. You can do monthly, what they call borrower paid, which is pretty much the same thing as what this is over here on the FHA side. Then they have what is known as lender paid, and then they also have something called a lump sum insurance premium. So borrower paid is the one that most people are familiar with, where they add $100 to the monthly payment, and away you go. The next one over, lender paid, is where they jack up the interest rate on the deal, and there's no specific mortgage insurance on it. So the lender is going to pay it in the way that they do it is they increase the interest rate. So if the going interest rate on a particular client, let's say it's at 4%, and they want to go with lender paid mortgage insurance, maybe the rate goes up to 4.375. So that cost is embedded into the deal. They also have something called lump sum mortgage insurance, and that's where there's a calculation that is done. Let's say you've got somebody, they're putting 10% down, and they don't want to have the monthly insurance costs. They just want to pay for it all at one time. So there's a calculation that they do. They come back and they say, okay, this lump sum premium is going to end up being $6,500. And then they include that $6,500 into the transaction. Okay. You guys don't need to know how that works. I just want you to be aware of it. These are the options that we as loan officers will go through with the clients when we're presenting the different loan options to them. All right, so on this first screen, Here's the main differences. We got a 580 score here, 620 score here. Everybody can get in at 3.5, no matter if they're a first-time buyer or not. Over here, you can only get a 3% down payment if you're a first-time home buyer. FHA has the one-time 1.75. Conventional does not have that. FHA is just on a house that you live in, whereas conventional, it can be on a second home or a rental, and you've got some options with regards to the mortgage insurance on the conventional. Okay, screen 2 on the comparison chart. Neither one of these products has a prepayment penalty. On neither one of these products is the loan officer legally allowed to talk to the appraiser. On a VA loan, we are allowed to talk to the appraiser. Okay. Property types: 1, 2, 3, 4 unit condos, PUD, and townhomes. On a conventional, it's 1 unit, 2 units to 85%, and 3 and 4 units to 75% loan to value. Rates, fixed and adjustable, same over here. Escrowing, over here on the FHA side, you do not have the option to escrow or not escrow. They will put a gun to your head and say you are escrowing. Whereas on a conventional loan, if you're putting 20% down, then if you want to pay your own taxes and insurance, they'll allow it. But only if you're putting 20% down. The reason for that is it has been statistically proven that people that do not escrow are 3 times more likely to go into foreclosure. So it's a little bit more risky of a deal, and they don't like the risk. Also, if you do have somebody that decides they want to handle their own escrow account, most lenders have a hit to the interest rate on that. So be aware of that. It's not much. It's normally like 1/8 of a point. So instead of them getting 4, they're going to get 4.125 typically. Seller concessions. You can go up to 6% seller concessions on an FHA loan. On a conventional loan, it varies depending on how much money they're putting down. If they're putting down the minimum, then it's 3% seller concessions. If they're putting 10% down, it's 6%. And if they're putting 25% down, it goes up to 9%. One of the questions that I get is, well, what are the normal closing costs and what's the normal amount of money needed to set up the escrow account? So my rule of thumb, when anybody ever calls me and they say, hey, my client wants to buy this $200,000 house, they're going to put 5% down. How much will they need for closing costs and setting up of the escrow account? My rule of thumb is it's 2% for closing costs and another 2% to set up the escrow account to pay the property taxes, and the basically they have to pay 14 months worth of a homeowner's insurance policy. The lenders will make them pay a full year of premium paid in full at the time of closing, plus a 2-month cushion. So that 14 months worth of homeowner's insurance, plus however much money they need to set aside for the property taxes, that's typically around 2%. All right. They do allow gifts on both of these programs. Debt ratio, here's the big difference. On a conventional loan, we go just under 50%. On an FHA loan, it's at 56.99. Okay. So that 56.99 is very relaxed. Now, one of the things that I'm going to explain to you guys is these are our rules and our guidelines with AMP, America's Mortgage Professionals. A lot of my competition, their debt ratio cutoff across the board on every one of their programs is either 43 or 45%. That's like with 90% of the people out there that are loaning money out. Hi guys, I didn't see you sneak in. So the fact that we're going to go to 50% on conventional, what that means to you and your buyers is the people that other people will turn down, we will get approved. And the people that we would approve anyway, we're going to be able to get them approved for a higher dollar amount because we have that relaxation on it. And it really holds true on the debt ratio on the FHA products. I'm going to give you a quick example. I had a kid that started to work for me 2 years ago. He came from Wells Fargo. They maxed out the debt ratio at 45%. And I gave him a file to put together and said, hey, tell me how much you'd pre-approve these people for. So he took it, worked it up, brought it back to me, and he got them approved for $215,000. But I noticed he had the debt ratio cut off at 45%. And I asked him why he had done that, and he said, well, I thought that was the FHA guideline. I go, no. The true FHA guideline is that 56.99, which we go to. So I asked him to go back and refigure it at the 56.99 number, which he did, and the loan came back at $282,000. So it went from $215,000 to $282,000. Okay, and you guys all know the market here. You know how tough it is to find a property in the low 200s in an area that you would want to live in without packing 2 guns and reloading ammunition, right? Okay. Yeah, you're gonna have to reload to go home. If you go to the mailbox, you're gonna have to pack 3 guns. Okay. So by us being able to go to 56.99, we can get a higher amount done. And it's a lot easier to find somebody a house at 282 than it is 215. And I know nobody in this room is in this business to make money, but the commission on 215 was about $6,400. The commission on the 282 was $2,000 more. Joe knows that. Okay, also relaxation on with regards to major derogatory events, bankruptcy and foreclosure. So on bankruptcy on an FHA loan, it's 2 years after discharge. Bankruptcy on a conventional loan is 4 years after discharge. Foreclosure, it's 3 years after satisfaction versus 7 years after satisfaction on a conventional. So a little bit more restrictive. One of the things that we have to look at, and I'm just making you be aware of it, you don't need to know this per se, but on the 3% down payment programs, some of them have restrictions with what is known as the area median income. Each county has an area median income. I think ours is somewhere around, $80,000, somewhere around in that number. So in some of these 3% down payment programs on the conventional side, the buyer has to be at 80% of the area median income. And we're going to do all this for you, but I just want you guys to kind of be aware of it. So when I have to go and do an area median income deal, this is the chart that we go to on the Fannie Mae website. So we'll put in a zip code or we'll put in a street address. Once you've actually selected a property, then we'll put in the street address and we'll go to this thing and it'll come up here and it'll tell us 80% of the area median income is in this particular area was $51,680. 100% is 64. Some of the programs that we have, we're in the process of coming out with some programs for what they call down payment assistance. One of the programs that we're coming out with, they allow us to go to 140% of this area median income, which in our county I think is around 96,000, something in that area. This is the link to get to that area median income lookup off the Fannie Mae website. Okay, this chart is one we're going to spend a little time on. This really gives you the breakdown with regards to the differences that people really care about with regards to FHA and conventional. Okay, so this chart in this example, it's a purchase price of $350,000. The standard FHA down payment is 3.5%. And so this area over here to the left of the screen is a breakdown of that particular example of $350,000. And I've got some numbers in here with regards to what the credit score of the buyer is. and I've got information about what the monthly payment is, what the interest rate is, and how much the mortgage insurance costs. Okay? And then I've got it broken down over here as well for the conventional based on somebody putting 3% down, 5%, or 10 or 15%. And I want to show you the dramatic differences. And the main reason for this chart is some people will call me up and they'll go, I really don't want an FHA loan because it's got mortgage insurance on it. And that doesn't really do anything for me. Which isn't necessarily the case. It varies. But FHA, the mortgage insurance, in my opinion, it is not just a cost for cost's sake. The buyer actually gets something out of it. Typically, the FHA loan product, the interest rate on that is better than the conventional. And the worse the score is, the better it is for the client. So typically, if you don't have at least a 700 credit score, I'm not typically looking at putting you in an FHA or in a conventional loan unless you're putting a chunk of money down. Yes, sir.
So this particular insurance, who they benefit? The investor or
The buyer.
The buyer?
Mm-hmm.
How do they do that?
Okay, good question. Here, I'm going to show you. All right, so here's the thing on this. I'm going to break this thing down for you. I don't know which one of these screens is. This one, the little red thing works. On that one, it won't. But so with a 600 credit score, the payment's $1,543. The interest rate's 3.5%. The mortgage insurance is $243. Okay, that's what it is per month. At a 620 score, it's the same. At a 640 score, you'll notice that the payment goes down a little bit because the interest rate at 640, they give them a break in the interest rate. It goes from 3.5 to 3.25. The mortgage insurance is the same. So what I'm going to tell you, and one of the things I want you to pick out of this thing is, on an FHA loan, the cost of the mortgage insurance, the factor that they use, which is 0.85 on the majority of our loans, is always going to be the same. Whereas on a conventional loan, the mortgage insurance is dramatically different depending on how much money they're putting down and what their credit score is. So on our FHA product, the mortgage insurance all the way through, all the examples, is $243. On a conventional loan, in the 3% category, if they have a 620 score, the monthly mortgage insurance is $636. Okay, huge difference. That's why I'm telling you, I would never put anybody with a below 700 score in a conventional loan if they're putting 3% down, 5% down, or 10% down, because the cost of the mortgage insurance is so much more for those folks. On the FHA side, once again, it's government-backed, government-insured, all right? And the government kind of treats everybody the same. Whereas on the private mortgage side, their premium, their cost, is determined by the score and the down payment amount. Whereas on FHA, it doesn't work that way. Everybody's kind of thrown into the same bucket, especially once you get above a 640 credit score. Look at the interest rate. 640 over. Now, this chart's 4 years old. So these were the interest rates, what it was 4 years ago. But the philosophy behind everything is still the same today. All right? So one thing to point out for you guys is whether you had a 640 credit score or an 800 credit score, you were going to get a 3.25% interest rate. Yes, ma'am.
Does FHA still do the 2-1 buy-down?
No, not really. No. They used to. But I think they were doing that more when the rates were in 7%, 8% deal. Now that they're below 4%, there's no need for it. Now let's look over here on the conventional side. First of all, conventional starts out at 620, and in this example, I started out at 600, but we could have actually went down to 580. All right. So conventional, you got to start out at a 620, and that interest rate with that score is 4.88% compared to 3.5. So it's a 0.25% higher, mainly because of the credit score, right? At a 640, it improves a little bit to 463. At 660, it goes to 4.5. At 680, it drops down to 4.25. 700, it stays the same. 720, it drops down again. Once you get above 750, it's at 4%. But look at the difference. It goes from 4 to 4.88. Whereas over here, we're at 3.25 to 3.5. Not a big spread, but a big difference between the two products. So this is where I always say to people, FHA, the mortgage insurance, isn't just a cost for cost's sake. You're going to get something out of it. You're going to typically get a better interest rate, and typically you're going to get lower cost of the mortgage insurance, and you're typically going to get approved for a higher loan amount, because I can also go higher because of the debt ratio relaxation. We can only go to 50 on conventional. On FHA, I can go to 56.99. So if you've got a buyer that's looking in any loan amount below the 373 number, probably there's a pretty strong chance we're going to put them in an FHA product. Okay. So let's look over here. This screen's a little bit clearer. So you can see the differences between the monthly payments. On this monthly payment, we're at $1,796 principal and interest. Over here at 3.5, we're at $1,543. So I'm no math major, but that's over a $200 a month difference, right? All right. Now let's look at the difference in the mortgage insurance. Over here, we've got $636 for mortgage insurance per month versus $243. So between anybody got a calculator out there, Joe? Add up $243, all right, and $1,543, and tell me what you get. $1,786. Jocelyn, remember 1786. Wake up. 1786. Now, Joseph, add up 1796 plus 636, and tell me what you get. 1796 and 636, and tell me what you get. Yep. I'm going to make him participate, huh? 24. Now subtract those two numbers and tell me what the difference is. Jocelyn, give him the number. 1786. So it's over a $600 a month difference between conventional and FHA. Okay. Thank you very much. So, you know, on the FHA, they have to pay that one-time upfront mortgage insurance premium equal to 1.75%. Okay. So somebody do me a favor. On $350,000, tell me what 1.75% of that is. $350,000 times 1.75. 350,000 times 1.75. Give me a number. Yes, sir. $6,100. Okay. All right. Now do me this. On that example, the monthly payment difference was $640, right? Roughly. So divide the $6,100 one-time upfront premium by the $640 and tell me how many months it will take you to break even. So as long as you plan on living in the house about a year, you're better off doing the FHA loan. If you're going to stay in it less than a year, which who buys a house and moves out within a year, right? So nobody in their right mind would do a conventional loan. Well, that's because they were drug dealers. Yeah, they were forced out by the feds. You know what I'm talking about. Okay, so let's keep looking at the differences here. So if they're putting 3% down and they've got a 620 credit score, we're 636 a month. If they've got a little bit better, at 640, it drops down to 579. At 660, it's 537, 396, 325. It doesn't get better than FHA until they get a credit score up above 750. Does everybody see that? that's why I've got this line here to kind of, anything above this is people that we would not put into a conventional loan. Anybody below that line would be clients that we would consider putting into a conventional loan because of credit score and down payment. So if you're putting 15% down and you've got a 620 score, I would consider putting you in a conventional loan. But I would provide both options. Here's another difference between FHA and conventional. On an FHA loan, your monthly mortgage insurance stays on there for the life of the loan. It's on there forever, okay? Now, the premium drops down a little bit every year, okay? The premium is based on the balance at the end of the 12-month period of time. Every year, on the anniversary date, it reamortizes. So let's say that the first year on this FHA loan, it's $243. The next year, it might drop down to $240. The year after that, it will be like $237, and it will continue to drop down a little bit by little bit every single year because it's based on what the balance is. On a conventional loan, it's what is known as a constant premium. It will stay that $636 until you get to 78% when it would automatically drop off. All right. Now, the question you want to ask me is, how long does it take somebody typically to get to 78%? And the answer to that question is typically somewhere between 10 and 12 years. So they're going to have mortgage insurance on a conventional loan for 10 to 12 years. So mortgage insurance will automatically drop off at 78%. The buyer can request that it be removed at 80%. And then they can make the request and the lender will look at their, basically they're gonna look at their payment history. Well, is this guy paying on time? Have we had any issues with this guy? And 9 times out of 10, they're gonna drop it off at 80%. Every once in a while, somebody will say, hey, I bought this house, I put 5% down, and then I remodeled the kitchen, I remodeled the bathrooms, I put a pool in, and now the house is worth a lot more. I think I'm at 80% loan to value. They're going to require that the mortgage insurance stay on there a minimum of 3 years. But at the end of the 3rd year, if that client wants to pay for an appraisal to prove to the bank that they're at 80%, then they'll allow them to do that, and then they could remove it off before that time frame. Okay, if they've done some work to the property. Yes, Joseph.
There's probably a lot of people out there then that are unnecessarily paying for that, not realizing, you know, this one had marked, you know, around 3 years ago.
Mm-hmm.
A lot of people have already changed that.
I'm going to let you go door to door and start telling people. Jocelyn, how about you and me? We hold hands with Joe and we start knocking on doors this afternoon. Will you go too? Okay, so now we got 4 of us. Tommy, will you go? Tommy's sitting this one out. Okay, so in my small print here, FHA characteristics. So we have the one-time upfront mortgage insurance premium equal to 1.75%. FHA typically has a lower rate. FHA is assumable, which I will explain. FHA has relaxed guidelines on assets and debt ratios, which I will also explain. FHA has a low down payment for everybody at 3.5 versus on a conventional, it's 5 unless you're a first-time home buyer. And FHA mortgage insurance reduces down every year on the anniversary date. Okay. The average credit score for buyers in Florida is 678. So the average person that you send me, we're going to probably put them in an FHA loan because their score isn't above 720. And it's not smart for us to put them in a conventional loan unless they're putting 15 or 20% down. So FHA has an assumption piece in it that conventional doesn't. Assumption means that somebody can assume that loan. So let me explain to you how that works. Let's say that we close a loan with somebody, and right now our FHA rates are about what they are on this chart. They've come back down. I quoted somebody at 3.5% yesterday. So let's say that we put somebody in a 3.5% interest rate, and he's in this house for 5 years, and he goes to sell the house 6 years from now. And the interest rate 6 years from now is back up to 7%. And there are 10 homes in his community that are very similar to his, and he's putting his house up for sale. But the other 9 have a conventional loan on it that is not assumable. This guy has an advantage over the other people because he can sell that property. If everybody's got a 3-bedroom, 2-bathroom, 2-car garage, they're selling them for $400,000, and there's not a lot of differences between the properties that are for sale in that community. But this guy's got an FHA loan at 3.5%, where if they buy his house, they can take over his 3.5% interest rate in his payment. Where if they go and buy somebody else's house, one of the other 9, they have to go out and obtain new financing at the current rate of 6%. So it is an advantage for somebody to have an FHA loan down the road. Okay? Any questions about this chart?
Yes, question. I assume you're probably, the rate's coming down quite a bit. You're just quoted 3.5%.
Yes.
Probably great rate.
Mm-hmm.
If you're on average of a $300,000 house, average score and everything else, what rate should they, like if they were at 5%, would you say, okay, we should refinance now? What rate would be worthwhile for them to say, am I worthwhile to refinance?
That's a very good question, Joseph.
Can you repeat it?
Yes, here's the repeatable question that Joseph just asked for the people that are online. So if you've got somebody and they're looking at maybe refinancing and they're at 5%, because about a year ago, the rates on a conventional loan were about 5%. So what we have to look at is what's the cost to refinance now and how long are they going to stay in that property? So my underwriters, we have a rule that the client has to recoup his closing costs within 48 months. If he can't recoup his closing costs within 48 months, we typically don't do the deal. It has to have what is known as a net tangible benefit. So one of the things that we look at is, okay, if we refinance this guy's house and it's going to cost, I'm going to pull a number out of my hat, it's going to cost him $5,000 to refinance. And the monthly payment savings is $300 a month. Okay, 300 times 12 is $3,600. So about the 22nd month, he'll be at a break-even point where he would have paid for that $5,000 in closing costs, and then anything over that is gravy. So that person would qualify. It would make sense for them to refinance. So it just depends on how much money we're going to save them on a month-to-month basis, typically. All right. But the old rule of thumb, I remember when I first got into lending 30 years ago, the old rule of thumb was you would refinance anytime the interest rate was 1% lower than what you're currently paying. That was the rule of thumb. But you got to remember 30 years ago, the average house, now I'm from Indiana, the average house in Indiana was selling for about, yeah, me too. The average house in Indiana was probably selling for $100,000. Okay. So I have seen instances where I'm dealing with somebody that owes $500,000 on their house, and I can drop their interest rate 0.25%, and it makes a difference. So the size of the loan also makes a difference in what's going on with the deal. If it's a smaller loan, sometimes it doesn't make sense to refinance it because you're never going to get those costs back. Because a lot of times the costs are about the same no matter what the size of the loan is. So you got to kind of look at every aspect of it to see if it makes sense. Okay, so I want to explain to you the cost of mortgage insurance here real quick. Everybody got a calculator on their phone? I want to show you real quickly how you can figure the cost of mortgage insurance. I'm going to get my phone out. Here I go. I appreciate that. So let's say that we're doing a $200,000 deal, and that's what the loan amount's going to be. So on an FHA loan, the factor that we use is 0.85%. So everybody put $200,000 in their calculator, all right? And then hit the multiply button, and then hit 0.85 and hit the percent key. And then hit the divide sign in 12, because this is on a month-to-month basis, and I get $141. So the monthly mortgage insurance on an FHA loan for $200,000 is going to start out at $141. Okay? So let's say that the first year he pays down the balance $5,000. So redo it on $195,000 and tell me what the premium is. $195,000 times 0.85% divided by 12, I get $138. Okay, so it goes down a couple of bucks every year as the balance goes down. Everybody understand that? Now, on a conventional loan, if the amortization is more than 20 years, so in other words, if it's a 30-year amortization deal, and they're putting 3% down, at 720, they're at a 0.87 on the factor. FHA is 0.85. So once you get below 720, the cost of the mortgage insurance is going up. 0.99 versus FHA at 0.85. 1.21 versus FHA at 0.85, and so on. So if they got a 620 credit score, that factor is 1.86, over 100 basis points higher. Somebody do 1.86 on a $200,000 deal and tell me what that is. $200 times 1.85%. Was it 1.85 or 1.86? Oh, I did it wrong. What'd you guys get? Okay. That's what I get too. So the premium on the other one was what, $141 versus $310? A dramatic difference in the cost of that mortgage insurance. I just want to kind of embed into your memory that that mortgage insurance can get very expensive with people with lower credit scores and putting down a lower dollar amount. Okay, so here's some differences with regards to the mortgage insurance. Is there upfront mortgage insurance on an FHA loan? Absolutely, and it's 1.75%, and that is an added expense. Conventional does not have that. Is there monthly mortgage insurance? Yes, it's 0.85 across the board on FHA, no matter what your credit score is, divided by 12. Is there monthly on a conventional? Yes, but it varies depending on your score and your down payment. Is there mortgage insurance amount constant? No. On FHA, it reduces down a little bit each year. On conventional, it stays the same. Can I cancel my mortgage insurance? On an FHA loan, the answer is no. It stays on there till it's paid off. On a conventional loan, yes. You can request cancellation at 80%. It will automatically cancel at 78%. Is the loan assumable? Yes. And on a conventional, no. One of the things I want to point out to you guys is, on the FHA loan, that mortgage insurance stays on there for the life of the loan till it's paid off. But one of the things that you need to know and realize for your clients, 75% of people will redo their mortgage in under 48 months. Okay? 75% of everybody that we did a mortgage for is going to refinance in the next 4 years. Rates got better. They moved. Getting divorced. Kids need money for college. They're going to add a pool. They need money for remodeling. So they're going to refinance, get cash out, or refinance because they want to go from a 30-year deal to a 15-year deal. There's 1,000 different reasons why people refinance. So when people say, yeah, but that mortgage insurance stays on there forever, the thing that you got to realize is most people, I've been in the business for 30 years, and that entire time I've seen 4 people get a 30-year fixed rate mortgage and pay it off over 30 years. It doesn't happen, okay? How many people do you know that have lived in the same house for 30 years recently? I mean, I remember back in the day, my grandparents lived in the same house forever, but now we are a transient society. People are moving all the time. People here go from east to west, north to south. They get a bigger house, a smaller house. The kids move out and they want to downsize, or they go from living in a house to wanting to buy a condo because they don't want to jack with maintenance. Yeah, exactly. So people don't keep those mortgages forever. So you don't really have to worry about the cost of having mortgage insurance on there for a lifetime, because you're not keeping the loan for a lifetime. You're only going to keep the mortgage probably 4 or 5 years because you're going to go on to some other transaction. So that's an easy way for you to overcome that objection with folks. Okay, so understand the difference. A conventional loan is originated in the private sector and is not insured by the federal government. An FHA loan is originated in the private sector, but it gets insured through the government, through the FHA, Federal Housing Administration. So in the bank's mind, an FHA loan is less risky because the insurance is backed by the federal government and they're never going to go out of business. Whereas the insurance on a conventional loan is underwritten by a private company. That's why it's called PMI, private mortgage insurance. Okay? Which is riskier? The insurance mentioned in the last slide protects the lender, not the borrower. Mortgage insurance is there for the protection of the bank. In the event they go into foreclosure, we can have a claim to be filed. If the homeowner fails to repay the loan for whatever reason, the lender will be compensated for the losses via the FHA. On a conventional mortgage loan, it can also be insured, but in this case, the coverage comes from a third-party insurance company within the private sector. It does not come from the government. That's why it is called private mortgage insurance, PMI. So here's a breakdown of a $360,000 purchase price property with somebody with a 660 credit score, and the differences in what they would pay. So the rate, 3.625 versus 4.875. Upfront mortgage insurance, $6,000. Nothing over here. Monthly payment, $1,612, $1,809, about a $200 difference in the monthly payment because the interest rate's different. All right, amount financed, $353, $479, $342. Why is this amount higher, Joe? Anybody tell me why this amount's higher?
Because to finance part of the money that you need to get the loan.
You're close. You're financing in the cost of that one-time upfront mortgage insurance premium. So that 1.75%, we're financing in this $6,000. They don't write a check for that. We add it to it. So they're adding it to this number and away you go. So we're at, well, we're not into that number because this one it's only 3.5% down. This one it's 5% down. So there's differences there. All right. Mortgage insurance factor is 0.85, which the insurance is $250. Over here it's 1.54 and it's $438 a month for the mortgage insurance. Once again, we're dealing with somebody with a 660 credit score, $360,000 purchase price. There's a difference in the interest rate, difference in the monthly payment, difference in the down payment, difference in the monthly mortgage insurance. All right. Total principal and interest and mortgage insurance cost, we're at $1,862 versus $2,248. So that's roughly what, almost a $380 difference in the monthly payment, right? Total outlay after 5 years. So how much money did this mortgage cost them after they've lived there in the house for 5 years? This one, it's about $112,000. And over here, it's $135,000. Even when we threw in the $6,000 for the one-time upfront mortgage insurance premium. All right. So this is where I come to people and I say, the cost of the mortgage insurance isn't just a cost for cost's sake. You're going to get something out of it in the way of better interest rates, lower cost for the mortgage insurance, and an overall lower monthly payment.
First question in regards to the rates. I don't know if that's the first slide, but are you finding that the conventional, in this case, is 1.2% higher than the FHA?
Yes.
Is that still, you find that
This is more of a current slide. If this guy had, like my rates right now for somebody with above a 720 credit score is at 3.99. You got it on, no, on a conventional. Mm. FHA, it's 3.5. Yeah, I don't put anybody in a conventional loan unless they typically have above a 700, 720 credit score, depending on how much money they're putting down. All right. At AMP, we will work up several different loan options and go through the math and provide our opinion on which loan is better fit. But in the end, it'll be left up to the client's decision. Some people, even though we tell them that, in our opinion, the FHA product is a better deal, they just can't get their head around the fact that it's going to have mortgage insurance on there. And they'll, what if I stayed in the house for 30 years? I'm going to pay out more money and da-da-da-da. So we give them the options, but ultimately it's up to them what they want to do. Okay, everybody take a snapshot of this slide. This is the phone numbers and email addresses of everybody on my team. So if you have, you know, Rachel's in here 5 days a week, but there's going to be times when she's not available or she's busy or whatever. And we've got, and she doesn't speak Spanish, she doesn't speak Polish, and she doesn't speak Russian. And as far as I know, she doesn't speak hillbilly or redneck, which is what I'm familiar with. Okay? So I'm your boy for that. But we've got Ricardo speaks Spanish, Agatha speaks Polish, we got Russian Rob here. Rachel, who's sitting in her office back there, who I'm going to bring out and introduce to you guys real quick. Has everybody had a chance to meet Rachel since she's been in here? No, Louis had to fire him. He wouldn't bring me back a Big Mac from lunch one day. Ricardo. No, Ricardo. Ricardo. Can you come out and say hello for 2 seconds? Thank you.
Hello.
Come up here and I want to put the speaker on you so the people listening on the internet can hear you. Come up front. Come on. I don't know.
I haven't met you yet. Hi,
Stand
everyone.
next to you.
Okay. Is this an interview? What are we doing?
No. So this is Rachel Escamanzi.
Escamani.
Monty. Who wants to throw an extra S in there? I do.
Also known as Mommy.
That's right. But she is, she's my favorite. Okay. She's worth $1 million. But she's going to be in here every day of the week, primarily. If she's not in here, you can reach her on her cell phone. She is very, very well versed in all of our loan products and has a fantastic personality, except when she has to deal with Tommy. Okay. Please say something.
That is not true. I love Tommy. It's you that gets me going. No, I'm kidding. Yeah, I'm just excited to be here, and I have so many deals in the pipeline right now. It's crazy. So thank you for all of the support. We've got an active one going right now for a person in the room, and yeah, we're excited about that. So if you have questions or need your clients to get pre-approved, the best way to do it is to have them complete my online application. And then once they complete that, we'll set up an appointment to kind of go over everything after they've uploaded their income and whatnot, because we try to make use of technology as best as we can. Other than that, I am here for just random questions and random consultations also. Can
you tell them how long it normally takes you to get somebody pre-approved? So I have an idea.
Oh gosh, I wish there was a right or answer to that.
If the client is participating in getting you the documents.
Perfect
scenario.
I mean, a perfect scenario, if it's not, you know, crazy self-employed income or bank statements and stuff like that. I mean, it can be done within 2 to 3 hours within the working hours, you know, not at midnight, of them uploading all of their income documents. I do try to be as responsive as I possibly can, you know, and there are some instances where it can take a day, sometimes 2 if we need additional things, but 2 to 3 hours is a pretty general rule if it's an easy deal.
Cool, thank you.
Make sense?
Do VA loans too?
Absolutely. Yeah, we'll do VA loans. Yep. We pay for the appraisal. You know that, right? Yeah, because you guys are location partners, we pay for the appraisal up to $600. So if it's an investment property appraisal, sometimes the borrower has to cover a little bit of it because those, if it's in the state of Florida, can be upwards of $700. But we'll cover up to $600 of it. So that's a huge selling point for your clients.
We did VA class recently. If you want to watch it, it's on the Sphere.
Somewhere.
Anybody else have any other questions? Any questions online, Tommy?
No, it's not like-
Yes. And if you need a copy of this presentation, just email me and I'll send it to you. Okay. And then I think somebody brought in some food in the kitchen, right? So there's munchies back there. Thanks for everybody for attending today. If anybody has any questions, just holler at me. Thank you. Bye-bye now.